Hello everyone, it's me, the Boss Hog. Today we're having a look at my portfolio as of the week ending the 27th of January. We've also got a trading update from Fevertree. We're going to talk about my time-weighted performance, which is now back ahead of our benchmarks. Just the one video this week as I've got both my daughter's 3rd birthday and my sister's 25th birthday. But all the same, we're going to go through this. So stick with me. Let's do it. All right, so in terms of stuff that I just want to talk about this week, I've got 3 points, and I thought this would be an interesting one to start with. Last week we were talking about a left-leaning think tank called Resolution. This time we're talking about a right-leaning think tank called Civitas. They highlighted some data from the Office of National Statistics that 54% of UK households receive more in benefits than they pay in taxes, equivalent to 36 million people. This is called the net dependency ratio, and basically that's a new record. First of all, I thought this was really interesting. It's basically been going up from sort of an average of low 40%, which is still already quite high, you could argue, in the late 20th century. Now, it did peak previously in 2011, and then it was gradually going down, but then a couple of years ago, it started to go back up again. But the general direction of travel is definitely up, but I think it is worth highlighting that this is the record. For me, it's pretty astonishing, really, when you think about what that means for the kind of long-term success of any country. I also thought it was really telling, and Civitas turned out a bunch of eye-watering stats. For me, the biggest one was that the top 10% of UK earners, which does include me, paid 53% of all income tax. I just think that's disgusting. I also thought the other thing that was particularly eye-watering was that is 3 times as much as the bottom 60%. Now, I guess there's 2 ways you can look at this. The best way, if that's quite the right word, is that people who are earning more are definitely paying a lot of tax. Of course, some detractors would point out that it still isn't especially fair because they're earning more in the first place, or maybe they are, we have a very unequal society, and therefore that's why this disparity exists, right? For me, it frustrates me a little bit, actually, not just because I'm in that top 10%, which is a nice problem to have, but roughly, like for me personally, it means I pay about £34,000 a year in tax, income tax specifically. That's before my national insurance, by the way, so you can put another like 6,000 on top of that as well. So it's a significant amount. But for me, I think it's very interesting. Like my first ever office job was in a finance department at my local hospital. I was there actually for several years on a 0 hours contract. So I used to work around college and university. And I always felt like it would be good to send people like a draft invoice for what their medical bills would have cost if it wasn't for the NHS. Because one of my jobs there was to send out private invoices. Like it was an NHS hospital, but we had a private wing, as well as a few other wings that were like money making, like a military wing and like a pathology lab and everything else. So we used to bill people like £3,000 for a standard pregnancy, right? Nothing exceptional, one night over in the hospital, no issues at all. And it was just like you go for a couple of thousand just on 1 or 2 diagnostics. A CAT scan was 1,000, and this is like 15 years ago, by the way, almost 20 years ago now. So for me, it's like one of those things that I think if people were truly aware about how much some of these things cost, it would actually make them a little bit more mindful about stuff. And I wish that we'd actually get a bit smarter with our data, kind of highlighting that actually higher earners, first of all, most high earners, I'm not talking about wealthy people, I'm talking about income. Most high earners have to pay full tax because it goes through the PAYE tax system, comes straight out of your tax packet, and other than a few things around like salary sacrifice for your private pension, there's very little you can actually do to dodge it. Like the people who are really dodging taxes are the wealthy who are able to like hoard their wealth and offshore it and everything else. Actually, high earners, like the top 10% here, I think you could call them high earners. I don't have a problem with that tag. But they also are very high taxpayers, and like I don't think it's like they're not pulling their weight. Again, I'd appreciate some people would disagree with that. I think the other thing here though does highlight the fact that income is uneven. But I'd also point out that like once you get to the top 10% of earners, it escalates like quite quickly in terms of like the top 1% are on like a significant amount, but then there's a huge drop to like percentage number 2 and a big drop, etc., etc. So one of the things that was also highlighted was like something like the top 50% pay 66% of income, so it flattens out quite quickly. But I just kind of thought that this was all very interesting. You can extrapolate a lot of worrying things, I would say, on the whole. I would say that it does show that high earners are paying a fair share of tax. Fairness is always an interesting word in any kind of debate, but for me, it doesn't feel like, from a personal perspective or an aggregated perspective, that this is like they're not contributing. And I think it's like one of these facts that although the intention of Civitas is presumably to highlight the individuals who are contributing, again, this is right leaning, so they're going to be pro individual. The right to make money is going to be part of that, right? I do think it's worth like everyone being aware that, again, this isn't rich people, because first of all, they're not necessarily rich, they're high earners. So let's keep that distinction. And those high earners are paying quite a lot of income tax. This doesn't include any other tax either, so like national insurance isn't included here, which again for any high earner is a significant amount as well. And it doesn't include things like VAT, where because that's a progressive tax, you would expect higher earners to be spending more money, and therefore paying more and things like that, etc., etc. So I just thought this was all very interesting and worth a read for anyone who's interested in a centre-right leaning pressure group, Civitas. I thought this was an interesting one to highlight to everyone. Now, for anyone who doesn't know, I think it's fairly well known I work in the telecoms industry. I also am heavily involved in the sort of regulatory side, so I'll be a little careful in what I say here because I do sometimes deal with Ofcom. But I thought this was worth flagging that basically Ofcom have launched an investigation specifically into BT/PlusNet. Now, PlusNet is owned by BT, but they run it as like a separate legal entity at a distance, but they are ultimately owned by BT. So they've launched an investigation into both BT Retail specifically and BT PlusNet. And the reason for this is basically twofold. So first of all, there's a regulation in the UK and most other European destinations as well. It was an EU directive that got interpreted by national governments, but most national governments in the EU and indeed the UK, obviously now we've left, have a contract summary piece of regulation that ultimately means your telecoms provider has to give you like a one-pager summarizing what you've committed to, what your notice periods are, right, how long you're in it for, what your monthly recurring charge is going to be, etc., etc. And on top of this, what a lot of telcos realized is that they could sidestep something called material detriment. That's Ofcom wording, which used to mean that during the middle of your contract, the telecoms provider couldn't change the rate you were paying because it was material detriment. And if they did so, then you got the ability to leave penalty free because they'd ultimately changed the terms of your agreement. So what a lot of telcos realized was that they could use this contract, and within the initial contract they could put a couple of words that would say something like, once a year we're going to increase your price by inflation plus 4%, right? And this is considered a bit of a money spinner. It's not just the UK, again, a lot of other jurisdictions have very similar approaches, both in terms of the regulator as well as how the providers responded. So this kind of contract summary had an unintended effect, which is that, again, from a UK perspective now, it allowed telcos to sidestep the material detriment and basically put in what has become extremely high revenue increases. Now, this has been a bit of kind of a fallback money spinner for a lot of telco providers. And for me, I'm surprised at how slow Ofcom has been. And again, I used to deal with both Dutch and German regulators especially. And I think all three jurisdictions have been relatively slow to react to this very obvious situation. Anyone who's worked in the industry has been very aware of for several years. And I feel like this is the start of the regulator basically having a look at it. And for anyone who's in things like Vodafone, which has a big presence in Germany as well as the UK, and the likes of BT, this is going to be a problem for you because a lot of these companies have kind of been using this to sort of plug gaps in other part of their business. And if the regulators do decide that actually you have no right to increase your prices 10% plus within contract, that's going to be a big problem basically. And I do expect that even if this kind of increase in your cost is allowed, that they'll start refining it. So like Ofcom again now, they allow for things like charging of non-direct debit payments, for charging of paper bills, right? But all of those things have a price cap. You can't charge more than X for those kind of admin charges. And I wonder if they'll start to consider things like that, like, okay, maybe you can increase it, but it's going to be capped at X. Excuse me. Or etc. So I just wanted to call this out. I think it's really interesting. To be clear, there's no resolution yet. The industry is being consulted as well. People can give feedback. My employer has given feedback on this kind of stuff, and I just think that it's interesting. It might also be of interest to people as well that Virgin specifically, they don't have this in their contracts yet. They've decided, evidently, that they are going to increase their prices and basically just hope that not too many people leave. So if you do get a price increase from Virgin, or indeed any other provider that doesn't have it in their contract, you can leave. You can basically notify them you're leaving, material detriment, and you can leave, because again, they've changed the terms of the agreement, so it basically gives you an exit. I think this is all really interesting. I think it will take a couple of years to fully flesh out. And again, just to be super clear, there's not necessarily the BT/PlusNet will be found guilty and be fined, which is what would happen. But it is, to me, more interesting that Ofcom has finally started to have a look into these kind of things, and it'll be interesting to see which direction it goes into. I just want to finish with a third point of big tech layoffs. This has been in the news quite a lot from various perspectives. I think something that hasn't necessarily been well recorded is that although some of the numbers are eye-watering, it's not a huge amount for the amount of workers that these tech companies have. And if you sort of compare it to even a couple of years ago, like, it's very clear that they're still absolute monsters who are running well ahead of their kind of 19, 20 numbers. And okay, you know, 21 definitely, they basically grew too fast. I guess that's what I'm trying to say. And for me, when I look at, like, you know, your Microsoft numbers, your numbers that are starting to come out from the likes of Salesforce, like, there are some weaknesses in those organizations, right? Like, if I think about Salesforce, you've got like very high marketing costs and very high stock compensation. So like you could easily show that their sales engine isn't as efficient as you would like to do, right? And maybe you could defend that in some ways, like it's hard to sell, but they have low churn. But again, I think that's a clear area for improvement. Microsoft, likewise, you know, they've got some, I would say, a slight distraction at the moment in terms of their Activision deal, but their cloud offering is growing really well. And, you know, they have some end of life stuff as well. So, okay, maybe that's going to have a detraction. So I don't want to like downplay it. I think probably Facebook has the biggest problems because of the technology change and their marketing issues, as well as being attacked by smaller players that are fast growing. But broadly speaking, I'm bullish on tech. I mean, especially once I break down my ETFs, we'll have a look at it in a sec. Well, I have like 40% of my portfolio in tech. Like, I'm incredibly bullish as a sort of guy who's 20 years away from retiring. I'm really bullish about the long-term opportunity in tech. And for me, it's no bad thing that these companies are getting rid of a lot of their excess, basically, like their fat within their business. A lot of these people that they're getting rid of aren't adding too much value from a productivity perspective. They're more or less like compliance and box ticking, you know, your kind of HR, PR, compliance functions. And again, I think it can be a distraction. I'm quite negative on those kind of functions on the whole, as long as obviously you're not being like completely breaking the law, etc. So yeah, for me, I kind of just, I don't feel like I've spoken about it really, so I just thought I'd address it here. Some of the videos are verging on funny, kind of where people are kind of going into Google offices and sort of you wonder how on earth they get any work done, because all they seem to do is basically go to massages and eat free food, and it's like a wonder how these companies got this big. And I think the simple answer is they were so absurdly profitable before that those costs almost didn't matter, whereas now they're just kind of still extremely profitable, but you know, they've now kind of started to take action because they realize if they don't get on top of it, these kind of staff costs, and you know, the average salary at these places is like $300,000, right? Talk about me being in the top 10%. I'm nowhere near the equivalent of $300,000. So these are like your genuine 1% earners. And you know, so those kind of costs build up very quickly. And so I think it's, if anything, good that these companies aren't wasting any more time. Yeah, they almost all of them have made a mistake hiring too much, you know, and what should happen is that a lot of the people who were there for a bit of a free ride, who weren't as productive, are going to be let go of, right? Again, I've heard of some videos that say it was almost random and they didn't have any guidance or expectation it was going to happen. I think that's actually rubbish. Like, I've been in difficult operational environments before. You kind of know that the business isn't performing well. You know that cuts might be coming. It's always a surprise when you get let go of personally, but it itself isn't a surprise, especially if all of your competitors have already done it, right? No one at Google should have been surprised that it was coming, put it that way. So for me, I think, yeah, it's obviously maybe it's worth a cry or a trip to the gym or however else you cope with bad news, right? But ultimately, it's just one of the things that businesses do, and I guess that's why for anyone watching, you should keep an up-to-date CV, up-to-date LinkedIn profile. Make sure you have good relationships with recruiters, etc., etc. Because these things can and do happen, and I suppose make sure you have an emergency fund and those kind of things as well. So, but as an investor here, speaking relatively objectively, I'm not concerned of any of my investments. I think this is a reaction to a slowdown and more importantly, actually an overhire in the first. So no concerns for me, and we continue to buy as you're about to see. So let's have a look at my buy sells, how my portfolio is performing, etc., etc. All right, so now it's time to have a look at our consolidated portfolios, which we manage through Google Documents. To start with here in Trading 212, so this is literally how my brokerage summarizes these accounts at the moment. We're now up to 131,500. Google Docs this week is very close. Again, my aim here is just to keep this at immaterial levels. There are differences in FX and buy and sell spreads, etc., but very close. And this has actually been closing over the last few weeks, which is good, so no concern. In terms of my week-on-week change, Google Docs was a bit slow to update on Friday evening, so when I crystallized this, you can see it's kind of gone up more week-on-week than my Trading 212 has, but again, that sometimes happens with the Google table that they use, so no issues there. We did add £1,000 this week. I was tempted to add a little bit more, but I have a holiday with my family next week, or the week after, and I've also got a business trip to Moldova in about 3 weeks that I need to fund. I don't have a company card, so I basically have to use my card and then expense it. So I didn't want to be like in Moldova and not have any money. That would be slightly awkward. So I didn't sell anything this week, so unrealized previous is my realized previous is unchanged. But it was a very good week, basically. So you can see here that this went up 4.8k. Very easy calculation. So it went up 5.8, but of that I added 1,000. So in terms of what was already there before, 4.8, and no dividends. So a very easy calculation this week, and generally moving in the right direction. That now leaves my portfolio at 131595 in Google, and again 131454. And for anyone who's new, this is the figure I used for my portfolio value on the thumbnail. And then this is the figure I use for my P&L, which is taken from Google Documents. Again, they should line up almost perfectly over time, which is really what these two measure. So the big news this week now is because I continue to outperform January quite significantly. I'm up like almost 14% for January. I've now overtaken the FTSE 350. This has been taking me a long time, right? Ever since my sort of Russian miners got hammered, I've been trying to recover, and now we are basically on top. There is something to flag this week, which is that when I was reviewing this data, I realized that in a previous month, I think it was October 22, I'd closed the S&P too early and given it a plus 6%, whereas actually it was plus 9%. So this red bar is basically nudged up for that period. So sorry about that. I did double check all of my other closes and they were all fine. It was literally that 1 month, and all I can think is that I closed too early and it had a busy finish or something along those lines. So anyway, double checked everything else now. I'm happy with my benchmarks and obviously super happy to have caught back up and finally overtaken the FTSE 350. This data is crystallized at the end of the month, so I guess we'll see. It is possible that it would finish the month down if next week is particularly tough for me, but definitely happy with kind of how I've recovered. I really think I kept my head, made some good decisions during 2022 despite a really tough start. In fairness, the whole of H1 was really rough, and then H2 I got it back together, and I'm really happy with how my portfolio looks and is performing at the moment, so that feels great. This graph I'm really hoping is going to be more and more flattering over time. Obviously last year again I was negative, now we are comfortably green, and what should happen over time is both this teal, which is my growth, so my basically capital gains, as well as my divvy here, which is this pink one, should just grow, and over time I would expect that to become more and more dramatic, sort of a decade into the future. I think this is kind of cool as well that my US profit now is at record highs, so that feels really good. My UK line is still negative. There's a bit of a shame, but obviously we're still making up for our huge fall here with our Russian miners, which are UK listed. In terms of performance this week, so I changed, the second change I made to this dashboard was that basically beforehand it was green if more than 3% and red if less than 3%. I just decided that it was pulling up too many week-on-week changes, so I've now changed this to +5 and -5 respectively, just so I can focus on real dramatic movements. I've also just added a 1 to 5 color scale basically in terms of my largest holdings. So yeah, gold place here is Amcor currently, silver is Gamma, bronze is Games Workshop, and then we've made up a couple of colors, which is kind of this. I don't even know what color is it, fuchsia, which is Genius. So they've been on a really great month, as you can see here. No real reason other than the fact, they did win a couple of lawsuits for people who were trying to use their data without their allowance. So that was good. And they seem to be running up recently, sort of just before earnings come out. And I guess there's and then it sort of goes down a little bit again and kind of normalizes. I would say that at 568, Genius is up to date with events. I think it's a reasonable, if not slightly above where I would expect it to be. And again, we are hoping that their Q4 results will basically give a profit for the full year. So, but again, very strong month to date and week on week. Oh, and speaking of, just when I'm talking about months, beforehand this was month on month change. I decided to make this month to dates because I think that's more relevant as we go through the month. So this is, you can kind of see from some of these huge jumps. Amcor here, plus 16, 17%. Genius has really contributed this month as well, and this is kind of part of the reason why I'm up sort of 14% on average. So if your sort of likes of your second largest holding is also up 10%, and then your largest is there, it's just been very good basically. Games Workshop not up hugely this month, but has had a huge run up since Amazon came along, right, etc. So this is all pleasing direction of travel basically. And then fifth here we've got Phoenix, which we don't talk about much. But yeah, I think it's worth highlighting. They're one of my more defensive plays, but I really like them, so that's great. 8% yield as well, by the way, so that feels awesome. So together, by the way, these make up an almost exact perfect 50% of my portfolio. So if these 5 companies are doing well, probably my portfolio is doing well. In terms of major moves here, Crichton is a consumer discretionary goods. It's got a very large spread and it's effectively a penny stock, so I wouldn't read too much into fairly volatile movements week on week. Genius we've already touched on here. Fevertree we're going to get to in a moment. This was actually down even more during the week and has had a bit of a recovery toward the end, but we'll touch on why that was shortly. Medical properties, again, this has had a fairly volatile everything last year, quarter, month to date, and week. No new news as far as I can see, but again, it's all over the place. Meta, kind of an extension of big tech changes and some layoffs, basically, hopefully becoming a more efficient business. Polymetal, we'll get to those in just a second as well, but to summarize here, they had a suggestion that they would look to move their London listing to Kazakhstan, which would be problematic for anyone who trades in the UK and doesn't have access to Kazakhstan Stock Exchange, which is going to be everyone who's not a serious investor, like a full-time investor. And then Redro here, sorry, that's Salesforce. Again, nothing concrete beyond the, Elliott obviously taking a stake, but I think a lot of that's already been factored in here, and some hope that the business is going to become a bit more targeted and a bit more efficient with how they go. So I think the 5% makes things a bit clearer. Our year to date here is, month to date here, I think is useful as well instead of month on month. So I'm going to do that moving forward. Lastly, here on this middle section, the £1,000 I added, I'll start with the largest here, which was I continue to add into the Scottish Mortgage. My average here now is in the 860s, so I am only mediumly red, almost down to single figures in terms of red. Again, I really like SMT. Like a few weeks ago, it was in the news because only for the second time in its history, it had more than 30% of its holdings in private companies. For me, it's awesome. It's my only way I can get an investment into private companies, right? I don't normally have that as an option. So I'm absolutely fine with their holdings. It's a high volatile, but long term, I hope to really make good money from SMT. So I've been using the opportunity to average down. I don't think I have a bad average, honestly. So that's great. Then we've got our iShares in Global Energy here. So I am modestly green on this now, so that feels good. I did have this in the past and then sold out for a modest profit because I didn't like the fact they had hydrogen as some of their largest holdings. I think their holdings are now a bit better. And to be honest, I just really want to have exposure to clean energy. I think that makes sense. It's very similar as well with digital security. Here I'm actually slightly red, but only very fractionally, like 0.5%. And again, I just know that I want exposure into a part of the global economy that I expect to grow significantly over time and that I have no knowledge about and no other holdings in. I did once try and buy a stake in Darktrace and that just worked out really badly, so I decided I didn't really know anything about cybersecurity and wanted to get away from it. But however, I would like an ETF, so that's fine. It's actually been relatively stable now for a little while, and I'm hoping that this will just grow over time. And then last but not least, It's my defensive consumer staples category. So I'm not going to lie, I hate consumer staples as a chunk. I have been in Unilever before from a pure value play. I don't even like that company either. The reason why I don't like consumer goods is like even this ETF trades on a big fat multiple of like, low 20s. I just don't really understand why, with the exception of Costco. I think a lot of the other businesses are declining long term, and I'm not super bullish on it as a sector. So I have been avoiding buying into this, but basically I decided to have another 100, and this is really kind of one of those like grin and bear it, just to give my portfolio a little bit more diversification. I expect that unless there's a huge crash in consumer staples, this is never going to be a massive part of my portfolio, probably like 1%. But it's really just to give myself some defensive weighting, and I decided to buy another £100. You can see overall here, my overall holding is only 700 at the moment. So, and again, I'm slightly green, just I seem to have caught a good entry. But I'm kind of like, yeah, grinning and bearing it. So I'll add £100 every now and then, but it's never going to be a huge holding for me. In terms, what this actually means then is my technology now over 40% of my chunk. It's interesting to see how this is shaping out. I don't look at this on a day-to-day basis, but I think as a combination of Genius doing especially well, the fact I've been buying both Scottish Mortgage as well as Alliance, and also like the digital security here, this also gets grouped into that as well. So it's basically just a lot of my new purchases as well as my performing in that sector, right? That includes my semiconductors, it includes my big tech. So all of that is just kind of meaning that not only am I buying more, but my chunk is performing well. So it's just becoming an increasingly large part. I might sort of think about capping this if it gets to like 50%, or kind of redistributing a little bit. But again, I think technology is a great position to be in long term, so I remain bullish on it. No dividend change. I don't believe I'm due any more dividends until the end of the month. There is one technically on the 31st, but there's no way my brokerage will clear that in time. So this is how I expect my dividends to finish. February should actually be really good, and actually much better than this. I realised when I was looking ahead to February that I had, this is the first time I tried to do future guidance, and both with Games Workshop and Hollywood Bowl, I was basically picking up interims and smaller previous numbers. Hollywood Bowl especially, I've known their number for ages, so I don't know why I didn't use their full dividend, because that's quite large. So actually, I'm expecting my February dividend to be closer to 400. But I didn't want to change it. Again, I think when it comes to next year and I'm setting expectations and guidance for 24, I'll see if I can be a bit smarter with my projections, and we'll just revisit at the end of the year. I don't want to frig it too much. And then just down here, there's just a couple of updates. So first of all, I decided that I would display here my ISA targets. So basically, this is going to match my current portfolio. So nice and straightforward there for what that is. And obviously our next target here, which is really difficult to hit really, is going to be September 24 of $250,000 in our ISAs. Again, I'm going to have to really go some, as is the market, in order to hit that. But this is entirely new, and I decided, because I mentioned it and somebody was asking me about it actually in Discord, this is my total wealth, which is broadly mirrored, as I touched on last week. Our ISA is about half of our total wealth targets. But I thought I'd also put this in basically just so we're aware. And you can see here our next target, which is also extremely ambitious. I feel like my second steps were just, both of these seem too ambitious in hindsight. But in my slight defense, the way that these are calculated is very crude average returns year on year. So for stocks and shares, it assumes an 8%. For my pensions, it assumes 6%. So both of those are impacted by a poorly performing market, which is down like 20%, right? So that's part of the reason. Obviously, if we overperform in the future against 8%, then I'll be running ahead, which is kind of what happened, especially with here, as well as here as well, right? So here, like, it was good that we met it because we had not much of a runway, but 21 was performing well, and then 22 we hit a bit of a car crash. So I guess in fairness, this looks almost unachievable, but I'd point out that we should be adding sort of 70 grand this calendar year between our pensions and our ISAs. So that straight away should take us to like 420. And then we'll see sort of how much more we can add in any other investments, how our pensions and our ISAs perform, etc., etc. But I do very much expect to miss this, basically. I think this is almost impossible to hit unless we get very fortunate somewhere. But this is our target, so this is how it works out, and we're just going to accept some variance over 20 years. and hopefully just tick through these milestones as and when, even if we don't hit them when we originally wanted to, which again was just based on long-term averages, not on anything more detailed than that, shall we say. So we shall see. Anyway, that's everything for my dashboard / portfolio update. We're going to be changing this table on our next video, because that will be like bringing these forward, because it's a rolling year. So we'll have some changes to discuss here. And then, yeah, these numbers will just get updated almost in real time as and when. In case anyone's curious, by the way, this is made up, a third of which is the ISA here. You can kind of see it just eyeballing it straight away, obviously more than a third currently. And then the other big chunks are my home equity and then our private pensions as well. They're roughly split 30% each. And then there's sort of some other investments, non-ISAs, etc., etc. So that's roughly how that looks. But yeah, nothing else to add here. By the way, I know that a few people have been asking like how I do these dashboards, etc. Now that I think I've finished making changes to it, sometime in February, I'll basically do an overview of how this works and you know, basically share my equations. If anyone wants to copy them or ask me questions, then please do. You know, it's not the most professional dashboard ever, but it's also free. So if somebody gets any value from that, then cool. As well as things like how to calculate your dividend summary and things, which is incredibly easy actually once you know how to your way around Google Docs. So that's on my to-do list as well, and I don't expect to be making any more changes to this portfolio dashboard moving forward. Next up, we've got a walkthrough of our company news, so let's do that now. All right, so in terms of the companies that I choose to follow and give details on in a little bit more detail than other companies and other holdings I have, actually a ton of them this week just don't have any. I think January is a relatively quiet period anyway, so just actually 4 updates this week of any real worth. So first of all, Fevertree, we're going to discuss them a little bit very shortly, literally straight after this. We've got a trading update to go through, so you'll see my thoughts on that very shortly. Next up, Polymetal here. So this is quite significant. So basically a really significant faller at times this week. And the main reason why was because in their earnings update, they basically flagged the fact that they were considering all possibilities. And one of them that's leading at the moment, their preferred choice, is to move to their primary listing to the Kazakhstan stock exchange. Now, this is a Russian-focused gold and silver miner. They do have businesses and mines, etc., in Kazakhstan as well. Obviously, they are somewhat impacted by everything that's going on at the moment. It is important to note that they haven't, either on a personal shareholder level or as a business, been sanctioned by the West in any way, right? Different to Evraz. But they basically are having difficulty trading because of everything, right? Where they're based, etc. They had a fairly moan heavy, I would guess, update in terms of how they're finding it, which was actually a bit of a shame because I thought overall the updates were reasonable. So, you know, they basically hit on their production guidance plus 2%, and their revenue was minus 3%, mainly due to ore price. But again, I would basically highlight that part of the concern with Polymetal was that they had a couple of aging mines. And what seems to be happening is that some of their newer mines are offsetting the production declines, which is what they said, in fairness, a couple of years ago when they were sort of, you know, you first make investment into mines. So from that perspective, the kind of output was pleasing. Overall, I would say that's more or less a wipe. So, you know, good considering the situation that they're operating in. But there was a concern here that, especially if they leave London entirely, right? Like if primary listing goes, but they keep a secondary listing in London, that would be one thing, because then, you know, the West and me as an investor still has access to the London market and the Polymetal. Obviously, if they remove the listing entirely, then it's going to be a problem because I'll basically be forced to sell and basically crystallize a 80% loss on this with about 3,000. So that would be a significant event, and obviously the market reacted really poorly to that, and almost, I mean, the market basically ignored the production and revenue update and focused primarily on that, which would be like an optional delisting. It wouldn't be forced in the same way that Evraz is frozen at the moment in London. And again, Evraz specifically has its listing in Russia as well as London, so a different situation. So again, if it had a secondary listing in London but it's primary in Kazakhstan, I think that would be okay. But there's definitely a concern about that, so we'll see how that develops over time. Next up, Genius here. So basically reinforcing their agreement with the Pro Golf Tour at PGA. They already have a relationship, but they're extending it. For me, there were two ways that they're extending it. The big one here is basically betting integrity. This is another revenue stream for Genius that they want to get more into, with some success so far. Now, the PGA do already have a third party as well, that Genius are working alongside with, so we'll see how that works out. But for me, any sign that a business where you already have a relationship is deepening that relationship is a good thing. They do already provide analytical data to players, caddies, and officials, and again, that's now being reinforced and developed further as well. So this is just not quite a contract win, but kind of a contract upsell and cross-sell, you could say as well. So for me, again, this is just good news. Genius has been on a bit of a run, as we just touched on, and it'll be interesting to see how their results look, but I'm optimistic for Genius. I'm expecting something like a £16 million profit for the year, so their first yearly profit, and kind of a very small profit in Q4, which is quieter just because of seasons, etc., of sports. So we'll see how that looks, and we'll definitely cover that next month. Kainos as well here, just a little one, a bit of a PR thing, but Kainos is actually one of the largest IT employers in Northern Ireland. They are funding a AI institute at Ulster University in Northern Ireland, so I think that's awesome that they're getting involved in that kind of stuff. I think it's one of these things that actually can be quite impactful, getting kind of your pick of like promising developers going through a university on a certain course is awesome. The AI focus as well is very cool, considering what Kainos do, right? They have their workday practice, which is the big call out, I suppose, and like the bread money that just pays the bills. And then they have their kind of custom development suite, which is where I guess this is going to link into, and that's your kind of like moonshoots and your real bullish case if they can get that far. And not that there's anything wrong with the fact that they're very profitable on their workday stuff as well. So that's good for me, and just worth sharing as a little bit of an update. Anyway, without further ado, let's have a look at Fevertree's trading update. All right, so as promised, let's talk about Fevertree. So first of all, this is a trading update only. For anyone who's not super familiar with UK holdings, this is very common. They'll basically do a trading update sort of 2 to 3 months before their full year financials. The trading update's normally like 1 to 2 pages. It has like a very high level, typically just revenue, sometimes earnings as well, breakdown, as well as sort of like a CEO giving some highlights and, et cetera, et cetera. So it is what it is basically, but I still think it's worth sharing. Trading updates are definitely very important and can move a stock price, especially if it reinforces expectations from the market, or obviously if it's very different, maybe that's actually a better way. So it's sort of like reinforces worries or optimism, I guess maybe that's what I'm trying to say. If it kind of reinforces worries, it's going to exaggerate a share price fall, and if it reinforces optimism, it'll have the opposite effect, right? I would say Fevertree's results here definitely reinforced pessimism. So let's talk about them now. I'm going to start with a couple of positives first of all. So for 2022, revenue targets here, bang in the middle of expectations. Their guidance was 340 to 350. You can see here 344. I'm going to class that as bang in the middle. It was interesting as well. I mentioned this a couple of weeks ago in terms of, this trading update was coming, and I basically said they needed like the middle of the expectations if they wanted to stay above £10. The market seemed to agree, but did react very badly. And at the moment, Fevertree is struggling to stay above the £10 level. But it was just about enough to give it a floor at that kind of level. My price target here has come down quite significantly because I think the business is poorer than it was 2 years ago for various reasons. But from a revenue perspective, they continue to look reasonable, I would say. Just to go into this in a bit more detail, off trade, so they have basically two ways to market. On trade is basically through pubs, restaurants, etc. Off trade is through retail, so through supermarkets. Historically, off trade was a much smaller component of them, but it was what they leaned on during lockdowns when obviously a lot of the pubs, restaurants, etc. weren't open. So off trade, so retail, down year on year, but against very tough comparables. That's especially true in the UK. The kind of lockdown timings and the financial years really aligned to give them very strong off trade growth last year. And now this year, that's had a bit of a retrenchment. That was expected, and one of the questions has been for the last year to 2 years was when on-trade starts back up, how much on-trade will cannibalize off-trade, and that's an interesting thing. Now, it's also true here that it's very fair to admit, first of all, that the off-trade comparisons year on year were almost going to be impossible to beat. So the fact that it was down, they don't express how much. But they don't call it like modestly or horrifically, so I'm assuming it's sort of like mid-single digits. UK strikes were called out, which is going to impact on trade, and really the UK revenue here was disappointing. Now, a few years ago, we're talking sort of 5 years ago here, Fevertree was like an absolute darling, but it started to run into some problems with kind of growth because it had almost saturated the UK, right? It was purely a UK business and it was purely a gin mixer business. And it was like, well, the UK has reached peak gin. That's what it's called, peak gin in the UK. And that's definitely a risk, right? That's why they've moved not only away from the UK specifically, which as you can see, it still makes up the single biggest region, although no longer a majority of revenue or earnings. But they've also moved away into other mixes as well. So again, that's an important pivot. I'd also point out that Fevertree published their update on exactly the same day that Diageo, who are one of the largest drinks companies in the world. I think they're second or third, but they're a huge drinks company, right? And a very good company, honestly. The only reason why I didn't buy their stock previously is because they're really expensive. But a lot of people are very bullish on Diageo, and if you can pick them up on a relatively cheap to them discount, I think their results, which were also quite badly received by the market, but their results looked a lot better. I'd rather be a Diageo shareholder at the moment than Fevertree's for sure. But one of the things that Diageo highlights that is beneficial to Fevertree is the premiumization of the market. That's definitely what Fevertree's strategic long-term focus is as well. It's one of the reasons why I'm in them. But they also flagged that gin sales were declining in favor of things like rum, tequila, and whiskey. So again, gin is a very UK focused drink anyway. But for me, even myself, like I've been into whiskey for a long time now, and I've recently got quite into rum as well. So I think it is concerning basically that they're maybe not as exposed as you would want them to be to other mixers. Saying that, I still love their cola. I think it is absolutely delicious with just about any whiskey. Kind of gives it a lovely vanilla taste. So they do have great products. It's just they're less well known for them, and they need to make sure that they keep on top of that kind of marketing and brand and etc. One of the other main wins here was that strong UK growth was plus 23%. However, and I'm glad they called this out, 10% of that 23% was due to FX movements, so foreign exchange. So really you can look at that as like plus 13%, which is a lot less impressive considering their focus on the US at the moment. They put like new management team in, they're having a local bottlers, their local warehousing, right? They're moving a significant amount of production into America. Last year, that was a problem because they were impacted heavily by freight costs, shipping costs, as well as glass costs, which continues to be a problem. And likewise, they ran into port congestion this year as well, where they've been still heavily reliant on imports as well. I would say that Europe would have been even better. It actually had slightly negative FX of between like 1% and 3%. But their on-trade revenue was a highlight here. So they've been able to grow faster into revenues and pubs in Europe. So that actually was slightly better than I was expecting. I was kind of expecting high single digits here. Like if I'm honest, I think it was arguably even a better highlight than the US, especially once you bear in mind the FX impact. Like 23% looks amazing until you halve it for FX. The European ones was even better. The Europe total revenue here is the one to look at basically, which looks at kind of non-branded versions as well. So that's an interesting, very small part of their business that they still have. And then rest of the world there, which is sort of Canada and Australia focused. So the profit for 2022 is expected to be 39 million. Again, that is smack bang in line with expectations. The problem for me here is that this profit margin continues to reduce. And, you know, like a year ago, they were having like this plan of how they'd get back to like the 30% margins of yesteryear by the end of the decade. That just hasn't happened yet. And, you know, it's not like they're like 2 years behind on that plan already. And it's disappointing from that perspective, basically. I feel like the bull case of Fevertree is actually getting weaker, not stronger, overall. So, yeah, okay, 2022 is fine. And likewise as well, revenue guidance for next year, I would say, is actually quite solid. Like if they hit 398, I would say that's really good. But I think the problem with glass, which is a major component of their production cost, is still an ongoing problem. Their margins are basically being away from. And really the final point here, I think, is the most concerning, which is even though they're expecting this fairly large jump in revenue guidance, and by the way, they've got like 390 to 405. Whenever I give revenue guidance, I'm not putting in ranges, I'm just going to stick it in the middle. Yeah, that's the midpoint of their guidance, to be clear for anyone who's new to my channel. But their future earnings expectation, they reduced from 47 million to 39. So basically same profit as 2022, despite the fact that revenue is meant to go up the better part of 20%, right? I think that's really shocking. And to me, it shows you that they still haven't got to grips with cost yet. So like for me, if I'm having this same conversation in a year's time, I'm probably going to be selling my Fevertree. I think that would have been enough time to this new chair of the non-execs from SAB Miller. I'm expecting him to do his stuff and start asking difficult questions about cost management, their strategy, returning to higher margins and ultimately higher earnings to justify these kind of multiples needs to happen. Their local bottling should help in terms of freight costs and logistics costs. And really, I want to see some improvement eventually. I can't keep waiting for jam tomorrow. And for me, I feel like I've given Fevertree enough credit. I've gradually reduced my price target as the business has become less impressive. And right now, I struggle to even see this kind of valuation at 1.2 billion for the business. I feel like this should actually be less. I'm kind of surprised almost how well the share price held up after some of this future guidance. And although there is some mention about like we should start seeing a fall in glass costs and everything else. I'm just very skeptical at the moment of the management team. Ultimately, it's a founder-led business still, and I'm starting to feel like he's run out of ideas, and I'm sort of getting to that stage of my investment actually. So yeah, I've definitely become more pessimistic on my holding in Fevertree. It's not a massive position for me, and I have bought and sold Fevertree in the past, so incredibly, I'm actually still up overall. But in terms of my unrealized position, I'm definitely red on this by about 20%, which is several £100. And yeah, for me, if I'm still having this conversation in a year's time, I'm basically going to be ditching Fevertree. What I would need to see in a year's time is basically some signs of margin improvement, better growth from the US, and really actually some more modest return to growth in the UK. I kind of want to see that in the mid-single digits. The US needs to be closer to 20% after any FX impact. Europe, I'm actually kind of happy with 15% year on year. And likewise, rest of world here is fine as well. It's a much smaller part of their business. So that's really where I need to see, as well as kind of a return to this sort of medium-term strategy to get them back to 30% margin and to justify these kind of high multiples. Right now, on a 31 forward PE basis, I'm really expecting something like Microsoft worthy, right? Or something that's just incredibly good. And it's honestly not Fevertree. So if I was to score this out of 10 with like a 5 in the middle, I'm giving this like a 3. There's a couple of highlights for sure, but broadly this is just more of the same and like no real marrying back to the strategic plan, which is really what I'm hoping to see when they publish the full results. But yeah, I mean, I rewatched a couple of my like points that I've made in previous videos, and to me, like what I would like to see is getting closer to that plan. Like if they can get back to their 30% margin, then they can justify a 30 PE, right? And in fairness, in the past they were trading closer to a 50, although you could definitely argue that was a bit steep. But 31 is for this kind of quality of a business right now with these kind of future guidance. Yeah, this is expensive. Like if I wasn't holding Fevertree, I see no reason to buy it. And as I am holding it, I'm actually more tempted to sell. But again, I'm going to give it 12 more months at the most. And if there's no improvement, then we're going to be getting rid of it. It is what it is, unfortunately. I continue to still buy Fevertree, by the way. I still very much like the product, but just not the investment case at the moment. Anyway, that's all I've got to share for this week. I think my plan, by the way, for next week is I'm going to do a Thursday video because I'm going on holiday on Friday. So I'm going to basically do an early week close. I'm not quite sure what's going to be happening on holiday. I may or may not do a video if I feel like it. I'm going to just put no pressure on myself and see how we do. For now, I don't really have anything else. Hopefully everyone else is having a lovely January as well. It feels very nice in the markets at the moment. Hopefully this was useful. I'm going to try and put in timestamps which one of my subscribers requested. We'll see how that goes very shortly. Otherwise though, thank you very much for watching everyone. I've been the Boss Hog and good luck with your investing. Bye for now.